If you asked most Americans what the biggest threat to their retirement is, what do you think they'd say? Some would probably say it's a big market crash, wiping out a big chunk of your portfolio, like what happened to many people in 2008. Others might say it's actually inflation, quietly raising the cost of living and squeezing your lifestyle year after year. But in reality, your biggest threat is neither of these. The real threat to your retirement is taxes, or more specifically, taxes that you never saw coming. Because the truth is, many Americans are needlessly giving away tens or even hundreds of thousands of dollars to the IRS over the course of their retirement. Not because they did anything wrong, but simply because no one ever showed them how retirement income is actually taxed. I'll give you a quick example. A retired couple once came into our office thinking everything was fine. They had saved responsibly for decades. They had just under $800,000. They owned their home, no debt, no problems. Or so they thought, because when we sat down and mapped out their retirement income and future tax exposure, the results shocked them. Without changing their lifestyle at all, they were on track to pay more than $300,000 in unnecessary taxes over retirement. And that conversation changed everything for them. They realized that they were potentially in trouble and they needed help. So where did they go wrong? Well, most retirees spend decades doing exactly what they're told. They contribute to employer retirement plans. They roll money into individual retirement accounts. They defer and delay taxes for as long as possible. This all sounds smart, and it is until you hit retirement, because now every withdrawal counts as taxable income. Required minimum distributions force you to withdraw income even when you do not need it. Social Security income becomes taxable. Healthcare premiums increase based on income. And suddenly, your tax bracket is much higher than you expected. You didn't eliminate taxes. You only postponed them. And postponed taxes can easily become larger taxes later. This is the retirement tax trap. So today, I am going to show you 5 ways you can avoid this tax trap and legally reduce the taxes on your retirement income. And if you follow just one of the strategies in this video, it could dramatically change how much money you get to keep for yourself and your family. Let's get started with strategy 1, using your low tax years smartly. One of the most overlooked opportunities to reduce your taxes in retirement happens early on. The first few years after you stop working are often your lowest tax years because they're before any required minimum distributions kick in, before you start getting your Social Security and the taxation for that starts, before all these different income streams start to stack up. These early retirement years are a brief window of opportunity. Most people let this window pass by and therefore let the IRS dictate later when and how much they should pay in tax. But smart retirees use that window intentionally. They withdraw strategically. They convert assets. They recognize income, not randomly or emotionally, but in a way that greatly reduces their future tax burden. Moving on to strategy 2, how tax-free income can change the game. Many retirees have most of their retirement savings in a 401k or IRA, where they grow on what's called a tax-deferred basis. Now, tax-deferred savings can be good, but it's important to know that it's not the same as tax-free. Tax-free means the Internal Revenue Service can't touch that money, but tax-deferred means you will pay taxes on it later when you withdraw it as income. This distinction matters more than most people realize because the most efficient retirement plans actually use 3 types of money: taxable money, tax-deferred money, and tax-free money. This 3-pronged approach creates flexibility. Flexibility means you can control how much taxable income you show in a given year, which means you can keep yourself in a lower tax bracket, you can control how much your Social Security is taxed, and you can control how much your healthcare premiums are. With flexibility, you control the outcome. But without flexibility, you lose that control. And so you will often end up paying much heavier taxes. In fact, 2 retirees can have nearly identical portfolios, same age, same lifestyle, same spending needs, but one can end up paying nearly double the retirement taxes of the other, simply because one had flexibility and the other did not. It's not an exaggeration to say that your financial flexibility can determine whether you run out of money in retirement or not. But all this begs the question, how can you move some of your tax-deferred savings and turn it into tax-free money? And more importantly, How can you do this without paying more taxes than you need to? This is exactly the type of thing we help retirees with every day at Bunza Wealth Management. If you want to see how this could apply to your situation, go to the link below this video now to schedule a no-cost call with us and learn more about how we help our clients long-term. Next up, let's look at strategy 3, reducing taxes on your Social Security. Here's a fact that surprises almost everyone. Up to 85% of your Social Security income can be taxable. And Social Security is not taxed in isolation. It is taxed based on what other income you have, which can include withdrawals from retirement accounts, pension income, and investment gains. The biggest mistake retirees make is not having an income plan, which often leads to them pulling money from the wrong account at the wrong time. And this can push you into a higher tax bracket and have devastating knock-on effects for your Social Security. Remember, the goal is not eliminating taxes entirely. That's impossible. The goal is smoothing out your income, because when your income is smooth, the fewer tax thresholds you cross. And when fewer thresholds are crossed, less of your money goes to the taxman. This is planning, not guessing. And this is closely related to strategy 4. The Medicare premium tax that most people miss. Most retirees believe that their healthcare premiums are fixed. They are not. Your premiums increase based on income. And again, if you cross certain thresholds, your Medicare premiums can jump significantly. They can easily go from less than $100 per month to over $400. Imagine that happening for both you and your spouse. And here's the worst part. The income event that triggered your higher premiums can happen up to 2 years earlier. This is where reactive retirement planning completely fails, while proactive planning prevents this entirely. Most people do not know this exists until they're already paying high premiums. This is why at Bunza Wealth Management, we do not simply manage your investments. We coordinate your income, your taxes, and your long-term planning together. We focus on what keeps your money working for you longer. So again, if you want to see how much you could legally reduce in retirement taxes, schedule a call with us using the link below. Now, to finish up this video, let's head into strategy 5, the hidden cost of waiting. Here is the uncomfortable truth. Retirement tax planning is highly time sensitive. Once your earlier lower tax retirement years in your 60s are gone, you have fewer options. And once required minimum distributions kick in during your 70s, your flexibility shrinks dramatically. The damage is done, and it can be difficult or outright impossible to undo it. The earlier you plan, the more control you keep. Imagine for a moment what it would be like to know exactly where your retirement income comes from, exactly how much will go to taxes, exactly how long your money is designed to last for. No nasty surprises, no regrets, no wondering what you missed out on because you failed to plan ahead. That peace of mind is what smart tax planning can bring you. So if this video made you realize you may be paying more in taxes than necessary, your next step is clear. Click the link below to schedule a call and discover how you could dramatically lower your retirement taxes. There's no pressure on this call and no obligation to move forward if we're not a good fit. And remember, in retirement, it is not about how much you've earned, it is about how much you get to keep. Thanks for watching, and I'll see you in the next video.